Hello, everybody. Retirement income options and stocks of the week, January 9th, 2023. I'm going to go through energy stocks and then a few others and show you where we're at on the retirement income options. All right, so first off, I wanted to talk about energy and just update us again. We are seeing a warm weather winter in Europe. A lot of the energy stocks come off just a little bit because people are trying to trade the very current energy scene. We need to keep some things in mind. One, we know there's not really an energy shortage, but there's an energy shortage. What do I mean by that? It is a very manipulated system, and we should all just accept that at this point in our lives. If you've been an investor for a while, if you've been a student of history, if you've just read the newspaper for the last 50 years, then you know that the Saudi Arabians and OPEC manipulate the price of oil, and you should be pretty aware that the supply chain of energy from Russia to Europe is damaged beyond repair in at least the short term. Even if little Vladdy left office or was killed tomorrow, it would take a long time to get those pipelines rebuilt and the energy supply line up and running again. So Europe has some pretty significant problems. Interestingly, the United Kingdom is in a very good position because they're generating an awful lot of their energy through renewables already. And when I say an awful lot, they had a week where 88% was generated by renewables. Now that was like the perfect week, and it's not something you should expect every day, especially when it's colder or hotter, but that's still pretty good. So we are seeing the whole world move in that direction, but it's going to take time. Between now and then, we're going to need a lot of natural gas, and we're going to need at least some oil between now and the end of the decade before it starts to roll over. The rollover on oil demand, which I think comes around 2030-ish, maybe a little bit sooner, not later, I don't think, but 2030-ish, as the EV revolution takes off, as more and more countries stop using oil to heat and cool themselves and power their industry, you're going to see a demand and supply imbalance because OPEC is simply not going to flood the market with oil again. And we have the Russia problems that are going to last at least several years. And in the United States, because there's been so many bankruptcies, the market is relatively tight. That's not even the most important thing. The most important thing is that there really is no excess refining capacity anywhere in the West, not even in the United States, which has the biggest refining industry. The only excess refining capacity in the world to speak of is in China, and they pretty much just use it for themselves. Now, will they start producing more fuel to export? Probably a little bit, but not much. So we have this decision and these circumstances that have flattened supply growth at about the same time that demand growth has also flattened, and they're managing the equation. In addition, the United States Strategic Petroleum Reserve is down in roughly half, I believe, and they want to refill that over the next few years. So it's going to be a tight oil market until mid-decade for sure, and maybe late decade. Between now and then, again, the energy stocks should do very well, especially the ones that can buy back shares. So the companies that are buying back shares, that are cannibalizing their shares, as Charlie Munger would say, are going to do pretty good. Shareholder yield is what we're looking for, not just the dividend, but can they buy back shares? And a lot of these companies will be able to do it because the price of oil and gas will remain at a higher level for at least a few years. I do think that it does head back to those 60s eventually that I've talked about in the past as the bottom of the range until demand turns over, and then the industry has to choose what to do. Now, I think that we get panic pumping, and that's what brings the price of oil down, again, 2026-ish, but we'll see. We're still not going to have more refining capacity, so at least fuels will stay rather expensive until demand for fuels goes down. But if we look at the companies on an individual basis and we take a look and say, okay, who's got growth, who's buying back shares, one or the other is good. So we take a look at these companies and we say, okay, who's got growth? Well, companies like SunPower for sure have growth. If you got government on their side, They've got Total on their side. They still own 1.5 million shares of Enphase, which is one of the reasons I'll only buy Enphase if I can get it real cheap, because I have exposure through SunPower and through ETFs. So SunPower has been chopping around in the teens now for a while. That's about as low as it's going to go. Now, could it go down $3, $4, $5? Sure. Get to 12? Maybe. If the world ends and we get the Armageddon zombie apocalypse, yeah, everything can go down more, but it'll be quick. And in the Macro Dashes article next week, maybe this week, I haven't decided which order to publish them in, I'll talk about why interest rates aren't the big boogeyman from the Federal Reserve, but rather it's the quantitative tightening. So if quantitative tightening doesn't come off later in the year like I'm talking about, if there's international events that cause more energy and supply chain issues, there's all kinds of forces out there. Ultimately, you just have to take a look at the longer term, stop thinking about the next several months, and just take the opportunities that are given to you in the short term that you can make a lot of money on the long term. The growth rates in solar installations are already around 30%. That's only going to go up for a number of years and only be constrained by the supply. Companies like SunPower are going to operate at capacity for a pretty long time until, like in the UK now, and as projected by FERC, we're at about 80% alternative energy in 2030 to 2035. So that's a pretty nice decade-long ramp up in alternative energy. Ametis, because the fuel situation can't be completely solved by solar power and electricity, right? Airplanes. Ametis is my breakout stock because there's a shortage of jet fuel, and they're one of the few new companies to provide extra refining capacity for sustainable aviation fuel. $7 billion of contracts in California. It's a big number. We valued the different pieces of their business a week and a half ago and came up with this company is probably worth $3 to $5 billion right now, but is trading at 150 million. If they sold this company for parts, if they parted this up, sold the renewable natural gas one direction, sold the sustainable aviation fuel another direction, sold India, I think you're looking at 3 to 5 billion right now if they parted it up. New Fortress Energy just paid a $3 dividend. Somebody asked, well, why did they do an offering if they were just going to pay it out as a dividend? That's not what happened. One of their early investors wanted a liquidity event, so they sold 3.3% of the company's shares, which they owned, to get the cash at $46. New Fortress Energy doesn't get any of that. That's just a large shareholder saying, hey, we've quadrupled our money here. Let's take some profits. And I believe they still own some shares. I would expect New Fortress Energy to continue to pay special dividends, but I think it's more likely that they start ramping up their share buybacks. If not this year, late this year, it'll be next year. Their cash flow generation is going through the roofs. Their earnings are going up quickly because their technology for putting liquefied natural gas directly from a deep water well onto a barge, onto a transport ship, they're the only game in town. Nobody else in the world is doing that. This is technology that only they have, and they're expanding quickly. If you take a look at the contracts they've gotten around the world, you can really see that this is another company that's only constrained by how fast they can move. I would expect New Fortress Energy to end up being $100 plus stock at some point. I think it'll triple in market cap at least, and it might do even better. And if they're buying back shares, right, the share price will go up quite a bit. Azure Global, not on the P&P anymore, just because they had some problems with management and controls. I really do think they have a bright future if they can execute and management gets everything going. So keep an eye on this. I took the tax loss. That doesn't mean that I won't own it again, but I want to see management do what they're supposed to do. The growth of solar in India is astronomical. So they're going to do well as long as they don't screw it up. But we've seen some hints of screwing it up. So let's keep an eye on it. Kinder Morgan just keeps chugging out big dividends. This is another company that could probably start doing buybacks unless they're taken over. I do think they're a long-term takeover target. Anytime they're in the middle teens, it's worth buying if you have a dividend portfolio, because there's really almost no downside to this company. This is an extremely safe dividend. Pretty much everything that they do is paid for And they just keep chipping away at the debt, This could end up being an extremely low debt company if nobody buys them out. But they're moving in the right direction, and they're in all the right businesses. They're the biggest natural gas transporter, the biggest carbon dioxide transporter, and we know that carbon capture is a big deal. And they're a backdoor play on hydrogen because natural gas pipes, unlike oil pipelines, natural gas pipelines can be converted to hydrogen. Enphase and SolarEdge are still on the plug and play. I've never been able to get them cheap since I let them go. And I have access through TAN, through the solar ETF and the other clean energy ETFs. So unless I can get them real cheap, I don't think I'm going to buy them. And in fact, as competition comes into the market, like from Generac, it's also a South Korean company and a couple others, as they get competition, as they move away from being a duopoly, they might come off the plug and play altogether and just become trading stocks. And if they're just trading stocks, that means that probably the whole industry becomes a trading industry once it gets to whatever plateau it's going to get to. So I'm not positive that I'll own Enphase and SolarEdge directly ever again, unless they get really cheap first. So if we get an Armageddon zombie apocalypse, hey, now they're back in view. Generac seems to have some risk of going into the 70s. Shooter and I both see it pretty similarly. I think it's close to bottom fishing right here. You see that the relative strength index is almost completely oversold. Shaken is real low, and the money flow is also pretty down. The Elliott wave oscillator is low, but it looks like it's stabilizing. So I think we probably have a pretty good chance here on Generac real soon. So remember, people liked it up here and I said, hold off. Now I'm saying just about get ready to pull the trigger. I don't own any yet, but it's on my short list. Shooter's primary wave setup is at 77. So I think a price in the 70s ends up being, I take that back. His first target 77. The primary wave setup is in the 60s. So somewhere in the 70s and 60s, I think, is where you really want to get involved with Generac. In case you don't know the whole story here, right? They do the generators, but they've taken that business and all those relationships, and they've moved into alternative energy, from fuel cells to solar and energy management. And they're really starting to move into the territory of Enphase and SolarEdge. Sunrun has the strategic relationships with Costco and Ford. I fully expect Sunrun panels and energy systems to be sold at Ford dealerships probably in 2025, a year earlier than the 2026 models come out. I think that they will be roughly synced, but probably in the next 2 years you see Sunrun being sold at Ford dealerships. SunPower has a relationship with somebody. It might be GM. I'd have to double check. But the ramp for these solar companies is spectacular. The challenge is getting them at the right price. So how low do they go in the short run while the Fed has quantitative tightening going on and the international risks appear to be so high? Remember, quantitative tightening really doesn't have a lot to do with the balance sheet, because that's just a super long-term mortgage on the country, and who cares? We're all dead in the end anyway. It has to do with the dollar. So when international risks are so high of causing inflation, the dollar needs to be extra strong. There are a lot of bets from hedge funds that the dollar is going to really drop. The last time that the bets on the dollar dropping a ton were as high as they are now, the dollar went on a 1-year run straight up. Now, I don't know if it's going to be quite that severe, but I do see the dollar having at least one more strengthening period. Will it get back to the top? Will it double top? Will it break out? I don't know, but it'll get close, and a lot will depend on the situation on the ground internationally and what markets are doing and whether or not they have to get some relief. Accidental, here's the same story as a lot of things. Buying back shares at some point, still paying a dividend, but more importantly, Berkshire got permission from the SEC to buy 50% of the shares. It's a takeover, folks. It's a slow-moving takeover. So anytime you can get accidental shares for under 60, buy them. And if you can sell puts that get you a net price of 60 or below, go ahead and sell them. Marathon Petroleum, not currently on the plug and play, but I want you to take a look at this chart. I wonder why these aren't popping out. It must be a Seeking Alpha thing. Look at the share buybacks. This is one of these companies that I was mentioning earlier just buying back a ton of shares, paying down debt. I mean, I identified Marathon as the best refiner way back. Oh man, when were we buying some of the companies that they ended up buying? Andeavor, they bought, whoever bought Andeavor, they bought too. So for about the last 5 years, I've liked Marathon Petroleum. Probably would have done well to just buy the dips all the way through. Now you know, but they're buying back a ton of shares. They bought back 20% of their shares last year, and they're going to keep doing it as long as they can. Now, will next year and this year be as good as last year? Probably not, but it's still going to be a lot of shares getting soaked up. So if you can get Marathon Petroleum with a dividend of over 3%, right? So that would represent a dip. You should probably do it. Other stocks of interest. Coinbase, if you are a Bitcoin believer, an Ethereum believer, and Ripple believer, and Chainlink believer, then Coinbase is worth your time. I own it through the ARK ETF. I owned it before that through DAP. I regret that experience. But the ARK ETF basically replaced a lot of the DAP holdings with Shopify. That's down like 80-90%. Shopify is a stock that I very easily could have put on here, and I might if it drops anymore. Right now, my exposure is through ARK. Unity Software, I think that this is a company that you have got to get very familiar with. What they do is so important in the worlds of AI, augmented reality, and virtual reality that people are missing it. They look at this as a stock that builds about half of the games on the planet, and they do. They have about half of the market share for the development of all games. But that's not the most important thing. I'm telling you, the AI platform and the AR and the VR, the development for industry, right? Industrial engineers using this stuff to build out their industrial systems is going to be bigger than the gaming. And the gaming's huge. You want to own this stock. Interestingly, on this correction here, right, it got bid up because of COVID and now it came back. It's the most searched stock by investors. There's interest out there, right? Somebody mentions that their M&A has been pretty good, and it has been. It's been very strategic, not willy-nilly buying growth. It's been about becoming either a duopolist or an oligopolist with a lot of barriers to entry against them. Oh, this one works. Who knows why? So I think it's right at bottom fishing. It looks like it may have double bottomed. And it's about to build a trend up. The Elliott wave is moving in the right direction. You're starting to see a divergence here with the shaken money flow turning up. Money flow index hasn't yet, but RSI has. So you're starting to get the divergences. Doesn't mean it can't turn over, zombies and stuff. There's a lot of people nibbling in on here. And I think we're going to start to see big institutions buying big hunks because they know what this is all about. This is a lot of the topics from CES that I'm going to be covering. So as you watch the CES videos that I'm going to have running on this channel and then macro dashes the next 5 days, what you're going to see is that everything, and I mean everything, is going in this direction. From games and entertainment to how industries run themselves, how repairs get done on stuff, logistics work, everything. Intel is one of my top 12 dividend stocks for the next decade. Yes, I'm going to write an article in my top 12 dividend stocks for the next decade. Ford and Intel are both on that list, and I think that they're both dirt cheap right now. They could both get a little cheaper, but not much. Take a look at the Elliott wave on Ford. It looks like Shooter and I are in alignment. I'm saying bottom fishing of 11. He's saying primary wave setup in the 10s. Again, can be invalidated by zombies, right? If the apocalypse comes, if Armageddon zombie apocalypse comes, all these supports can be invalidated, right? There's no guarantees. I don't think the zombie apocalypse, the Armageddon zombie apocalypse is coming. The AZA, should we just call it the AZA? I don't think the AZA is coming. AZA, whatever. I don't think we're going to see this sort of thing because if the Fed simply ends quantitative tightening, which it can do overnight if it thinks it needs to, all of a sudden there's not money coming out of the markets anymore. And all that slush that's around, and there's lots of it, especially at the institutional level, can come in and buy those beat up prices. So the signal you need to look for isn't so much the Fed saying, hey, we're going to start raising interest rates less, right? We're going to start doing quarter points and we'll see where we're at in a little while. That's not the important thing. It might get a rally for a couple of weeks, but that's not the important thing. The Fed balance sheet shrunk 2.4% last year. You saw what that did to the stock market. It is scheduled to shrink that much, pretty much quarterly now. And that's why this is why I think I agree with Morgan Stanley on the large caps. I think large caps have about 20% to come down, but it'll mainly be the companies that have only had a little bit of correction or not really corrected at all. And once that's out of the way, you've seen all the 80 and 90% corrections. That's it. The quality starts to rise again. And some companies will rise just because they're in the right index, right? They're in the S&P 500, but they won't beat the S&P 500 because any company that doesn't have growth, and now they have to do their financing at 6, 7, 8% instead of 1, 2, 3%, they got problems. If I'm right, and I'll stand on my track record here, if I'm right, the Fed's new normal, the new normal, is an era where interest rates are roughly normalized and we start getting out of QE and QT. And when they get rid of QT, which I think happens at least partially this year, if not by January or February of next year, but it could be gone by the end of the year. They could stop tightening the balance sheet by the end of the year. Now, all of a sudden, you still have a lot of money out there that can go into investments, but it'll have to be more selective. And the old man stocks with no growth that need to refinance periodically, as all those bonds come up for renewal in 25 and 26 and 27 and 30, right? From 2025 to 2030 is when most of them come up for repayment, right? These are the bonds that were refinanced during COVID. At that point, those companies really take it on the chin. Well, the market's not completely stupid. There are some smart people in the market and they hold a lot of money. They start to sell those stocks if, they haven't already been doing it with dumb retail holding some of the favorites up. I say dumb retail because it just is what it is. 4 out of 5 people don't do any reading at all. And it's just right. It's just reality. So moving over to the retirement income options, I'm looking for capitulation trades, Ford, Intel, Unity Software, SunPower. I think we're pretty close. I'm going to finish this up. I'm continuing to update these charts. I have most of the bottom fishing done now. Just got to fill it in, updating some of the options, pushing some of them out to March, even April and May. Why? Because if we get volatility, those premiums will scream. So we should be greedy about getting our premiums, and we need to think about how the strike prices work. And, certain stocks, I'm taking a look at when the earnings are. With Unity, their earnings are February 1st. I know that they're growing. I know that the market is schizophrenic. So I'm selling the longer dated puts. I'm going way more than 2 months out here. Normally I'm about 2 months out just to capture all this time value to get this higher premium. But still, it's a pretty low strike price. If you wanted to, you could do the $30, collect $8 or $9. Probably I'd have to do the exact comparison. I'm guessing you get probably 8. So your net cost would be 22 or maybe 23 versus 21. I'd be okay with that too. So I can even put an either or here. And I will, just for you. SunPower, does it have downside to the lower teens and 12-ish? It could. Again, Armageddon zombie apocalypse stuff. But there's so much growth here. It's just so much growth. And I want to kind of put Sunrun on here too. I don't want to overwhelm you with solar names when there's a solar ETF out there that's pretty darn good. So if you don't want to have exposure to this type of company from a standpoint of you having to manage it, then use the ETFs, right? Use the Invesco Solar ETF. Get the whole industry. Right. So I will finish this up this afternoon. Jolene is going to be gone for a few days down in Chicago with a couple of different friends. And so I'm going to work a lot and I will get this all up. We have the Fed and we have earnings coming up. So we're going to be a little bit cautious around those things. I'm going to try to play them from a tactical perspective. And I'm going to try to give you just a little bit more concise, right? People are asking me for more hand-holding or more hand-holding. I'm trying to teach you how I think about these things, which has generally been right, even when I've been early, and I've been early a lot in my career, trying to get it more precise with the technicals. With these 4 companies, and like I said, you can always use TAN if you don't want to just buy the solar companies individually, which I think is a wonderful strategy. But these 3 companies in particular, you got to get these in your portfolio if they're not in. Got to find ways to work on getting these into your portfolio over the next few months. All right, I'm going to put the CES presentations back on now, and I will see you, probably this afternoon. I will stop back in. And then I will rerun everything tonight at 7 p.m. All right, have a great day, and I will finish this one up.